Hello everyone, welcome to Yadnya Investment Academy. Today we will talk about part 2 of HUF series, that is how to save tax by forming Hindu Undivided Family. In part 1 we talked about what is HUF and parties involved. A tax professional is the last person you would expect to give you a matrimonial advice, but many chartered accountants often tell their bachelor clients to tie the knot. If you are paying too much tax and all possible deductions have been availed of, the only way to bring down the tax liability is by starting a Hindu Undivided Family, that is HUF. However, as discussed in part 1, you can do so only after you get married. So basically, the HUF is another tax-paying entity in addition to the individual taxpayers in a family. As a result, the family's tax liability gets reduced. Let's list down tax and other benefits of forming a HUF. HUF has its own PAN and files a separate tax return. A separate joint Hindu family business is created since it has an entity separate from its members. Deductions under Section 80C and other exemptions such as ATG, ATD, etc. can be claimed by the HUF in its income tax return as by the individual. Thirdly, HUF can take an insurance policy on the life of its members. HUF can pay salary to its members if they are contributing to its functioning. This salary expense can be deducted from the income of HUF. And HUF is taxed at the same rates as an individual. And lastly, investments can be made from HUF's income. HUF can invest in mutual funds, invest in shares, debentures, NSC, fixed deposit, etc. Any returns from these investments are taxable in the hands of HUF. Let's try to understand this better with an example. Let's take the hypothetical case of Mr. Raghu, a married man having 2 children working in the corporate sector and earning a salary of rupees 20 lakhs per year. He has an additional rental income of rupees 6 lakhs from inherited property. He also pays life insurance premium of rupees 60,000 for his family, makes PPF investment of rupees 1 lakh, and his company deduct PF of rupees 1,50,000 from his salary. He also pays medical insurance premium for himself and his family for rupees 20,000. So let's understand Raghu's current tax liability. Gross income would be rupees 26 lakhs by adding his salary and rental income. He would get rupees 1.5 lakh deduction under Section 80C due to investment of rupees 1.5 lakhs in Employee Provident Fund by his company. Even though he is investing in PPF and life insurance as well, but he wouldn't be able to get tax benefits for those investments as he has already maxed out his 80C benefit through EPF. He would also get rupees 20,000 benefit for his expenses to health insurance under Section 80D. So we get total taxable income, that is rupees 24.3 lakhs after subtracting this from gross. And based on current tax slabs, his tax would be 5.54 lakh rupees plus cess. So Raghu's current tax liability is adding these three, which is approximately 5.7 lakh rupees. Now let's assume that Raghu forms a new HUF and is able to legally shift his inherited property to this HUF. So the rental income from that property of rupees 6 lakhs will now be HUF's income. He also pays life insurance premium of rupees 60,000 and do PPF investment of rupees 1 lakh in his name from this HUF income. Let's see his revised tax outflow in this scenario. So now as an individual, his total income would be only his salary, which is rupees 20 lakhs. And after the deductions, his taxable income would be rupees 18.3 lakhs, which means his revised tax outflow would be rupees approximately 3.85 lakhs. Now let's see tax liability of newly formed HUF. So for Raghu's HUF, income would be rental income of transferred inherited property, that is rupees 6 lakhs. It will get tax deduction under Section 80C on the insurance premium it paid and PPF investment it has done. So the taxable income would be after subtracting deductions, that is rupees 4.5 lakhs. Now adding the tax and cess, total tax comes out to be rupees 20,600. So the total tax liability of Raghu before taking HUF advantage would be this, and after HUF would be this plus this, which is approximately rupees 4,06,000. So the total saving of tax due to HUF is difference between these, that is whopping rupees 1.64 lakhs. Thus from this example it is evident that if Raghu is able to legally shift the incidence of taxable income from his individual capacity to his HUF and make payment of expenses on which he gets tax deductions from his HUF, he is able to save nearly rupees 1.64 lakhs every year. Sounds too good to be true, right? Hence, overall, we find that Hindu Undivided Family surely is going to bring tons of tax saving for the individual, especially because of the innumerable tax exemptions and deductions which are scattered in the income tax law, which provides these exemptions and deductions to be separately available to the HUF. So in order to generate income and invest in the name of HUF and save tax, it is important to transfer capital to the HUF or generate income in the hands of HUF. How can you do that? We will discuss that in our next video, where we will understand how to create HUF and add capital to it. Till then, if you have any question, please do write in the comment section below. Have a great day ahead.